National Real Estate Trends Update. I'm Nick Elder with Ironton Capital. I'm joined here by Lon Welsh, founder of Ironton Capital, and Joe Massey with now Synergy One Lending.
Today, not a lot of confidential information because we're not talking about funds, so I'm going to probably skip through all of this. And let's talk about consumer confidence. So my goal is to get through most of this in about a half an hour or so, and hopefully we'll have a bunch of questions and answers that'll kind of bring a little bit of information to it. So I think the big story for what's going on a national trends basis is that consumers are just really bummed out. So the University of Michigan does a lot of studies of consumer confidence and their expectations. So on the left-hand side, you can see expectations drop to, about a 12-year low for the data I have on here. It's actually closer to like a 25-year low. And that's largely driven by the nonstop tariff discussions in the media and then the ongoing unrest in Ukraine. And fortunately, Gaza seems like it's mostly wrapped up now. But as long as we've got all this uncertainty in the market, it's not led to a lot of confidence on the part of consumers to do much of anything. The right-hand side is sentiment, just a slightly different way of looking at the same thing, and you can see that we're near the low range of the values there as well. So another part of the study is they ask, what percent of you think it's a good time to sell a house? And you can see that we've gone from about 80% agreeing to about 50%. So that's put a dampening effect on people wanting to list their home. But the real impact has been on the buying side. And you can see on the right-hand side, we've gone from about 75% of people saying it's a great time to buy. This is in 2017, and just 8 years later, we're down in the 10 to 18% range, about as low as this index has ever been. Joe, are you seeing this as you talk to your buyers as they pre-qualify for mortgages?
I am. Yeah, a lot of people are just apprehensive is the best way I would describe it. They'll call and they'll say, "Hey, we want to look at properties, but we're not sure." There's just a lot of nervousness,
Yeah.
and it's hard to like really pinpoint it. But a lot of people say the same things. We know it's a good time to buy because we're seeing price reductions and we're seeing that we can get seller concessions, but we're really worried about interest rates, taxes, insurance, and HOA. So it's this mismatch. But yes, I would agree that most people are saying it's not a good time to buy, but they're still having lifestyle changes. I'm pregnant, I'm getting married, I'm getting divorced, whatever it might be. But there's definitely apprehension is the best way I could describe it.
Yeah, I think that's everywhere. So I think we're going to see as we go through tonight, there's several different factors that are going to be likely to hold buyers back. And the first factor that holds buyers back is lack of confidence due to the headlines. If they're not buying, that means if they're supposed to be a first-time buyer, they're going to be a renter for longer. And for us, buying apartment buildings, that's good news for us. So interestingly, if you ask voters, how do you rate the strength of the economy? And the numbers right now are pretty strong. So eventually, I would assume that this would be a leading indicator leading to higher consumer confidence in the not too distant future, but that hasn't trickled through the system just yet. So you might ask, is the economy actually strong? And if you take a look at inflation rates, you can see that yes, they've been pretty stable in the 2.5% to 3% range, which is not a bad place for them to be at all. If you take a look at unemployment, it's been very steady around 4.25%, which is just phenomenal. So actually, our economy is doing really, really well. Although from the negative headlines you see from the politicians, you think that we're all about to die tomorrow. That's just not true. What, Joe, when you're talking to potential buyers, like what's their sentiment about the economy?
I would say most people are worried about losing jobs. Although this chart tells us the opposite, but I do hear people say it. They say, "Well, I'm not sure what's going to happen in the future." Again, just apprehension. They're worried is what I would say, and I don't necessarily know that those worries are bound in reality.
Yeah, I'd agree with you on that. There doesn't seem to be a lot of evidence supporting that, at least.
Mm-hmm.
Overall, the economy is doing pretty well right now. So a lot of renters are struggling economically. If you look at the left chart on the bottom, if you had any bills that you weren't be able to stay current on this month, and you can see for rental households, it's more than 25% are behind on at least one bill. And I think that's one more thing that's going to hold people back from becoming buyers. So if that was true, eventually you'd see that reflected in the percentage of people that own versus rent. The number of owners would go down, and the chart on the right shows you that that in fact is true. We've got a very gentle slide in the number of owners and an increase in the number of renters, which again for us as landlords of large apartment properties is really beneficial. Joe, are you seeing more of your applications for loans that have got more delinquencies?
No, but I think that's just unique to my clientele. I generally work with a lot of investors. I work with a lot of, medium net worth folks, and I work with a lot of folks that have really laid a solid foundation. So I don't get a lot of folks that are behind on their rent, and then they say, you know what, maybe I want to buy a house.
Yep.
So I'm pretty fortunate in that. I want to add maybe just one little piece of commentary here. On the left-hand slide where you've got rent or mortgage, so percentage of consumers with unpaid bills in the prior month, there's a tiny little red bar. Less than 1% of homeowners are behind on their mortgage. I think we've got some slides. We're going to talk about this, but I do hear some of that worry and apprehension. Folks are saying, hey, I want to get pre-approved now because I think there's going to be a foreclosure boom and I want to be ready to strike when prices drop. This is one of our leading indicators. There's not going to be a foreclosure boom. That tiny little red line, if there was going to be a foreclosure boom, it would be much, much bigger. So this is just kind of leading the witness into some of the slides we're going to have here shortly.
Oh, that's a great indicator. I love that. It's just one more way to validate the data that the homeowners in general are doing fantastic.
Doing pretty good, yeah.
It's a good time for them. Do you want to talk a little bit about just credit card payment debt kind of increasing and what it means?
Yeah, so credit cards have been going up more rapidly than at any point in the past. If you go back and you look at third quarter of 2009 to first quarter of 2010, that's a statistical anomaly that was a change in some of the reporting. So outside of that anomaly spike there, credit card balances are rising faster than at any time in history. And what that means is we're having a lot of people that are keeping up their lifestyle, which has gone up with inflation. They're keeping up their lifestyle by financing it. And eventually those chickens are going to come home to roost. We're going to see a lot of folks having to do cash out refinances or second mortgages or home equity lines of credit. And that's going to free up some inventory in the near to midterm future. As some folks, can no longer advance on their credit cards to keep up with their lifestyle, they're going to have to either make lifestyle changes or pay off those debts by tapping into home equity. And that's going to free up some of the lock-in effect as well, which is going to, I think, lead to more transactions. And again, the near to midterm future.
Yeah, I could definitely see all of that. So delinquencies, this is, I think, most important from the first-time buyer point of view. You can see that delinquencies on the right-hand side for student loan debt are up dramatically.
Yep.
And I think that's probably the biggest consumer debt headwind that we see that's very first-time buyer specific. All the other delinquency indicators are generally flat or up just a tiny bit and probably not all that material, but the student loans probably, Joe, they probably disproportionately affect the first-time buyers, I'd assume.
They do, particularly younger first-time buyers. I don't know if we have a slide in here, but the average age of a first-time home buyer, I believe, is now 34 or maybe 36
Yeah, it's a lot
years
older
old.
than it was. Yeah.
It's taken folks a long time to pay off those student loan debts. They finally get rid of those. All right, now we're ready to go buy a house. So I think delinquency is important, but also just the amortization extension. It's taking longer because folks have more student loan debt.
Yeah, it's a double whammy in a lot of regards there. So our price is going to drop. I think prices are going to, generally speaking, be soft, but there's some nuance that goes into this. The upper left-hand slide is from Redfin. It's their estimate of how many active buyers and sellers are in the market. So you can see through most of 2016 through 2020, the buyers and sellers were very much in lockstep. So it was a relatively balanced market in that regard. But recently, you can see that the number of sellers has been growing very rapidly while the number of buyers has been declining modestly. So now we have like almost twice, not quite twice, there's probably 50% more sellers than there are buyers. And we haven't really seen that behavior since maybe for just a couple months of 2014, early 2015. So with more sellers and fewer buyers, we'd expect less transactions to be completed, less appreciation, more concessions, and more discounts.
And that's exactly what we're experiencing.
Yeah, we're seeing all those things. So what's interesting is if you look on the lower right-hand side is that this phenomenon is not equally distributed across the entire United States. If you look at the Northeast and the Midwest, the buyer-seller demand is relatively closely matched still. That's largely because during the COVID boom of 21 and the first part of 22, the Northeast and Midwest didn't have nearly as severe of a run-up, And now that things are slowing down, there isn't as much of a correction that's required. Most of the COVID boom was in the South and Western states. And you can see we're paying much more of a penalty right now as a result of having those big swings up in the boom. We're going to be the first ones to see a little bit of a correction if there's going to be any. So no surprise there. This chart shows you the exact same thing, but it's broken out on a state-by-state basis. So if you're a seller, the red circles show where there's an oversupply of sellers and not enough buyers. So it's South and West. So, Washington, Colorado, Texas, Florida. And if you are a seller, ideally you'd like it to be the other way around, where it's a stable market, or ideally there's a few more buyers than sellers. And that's the Northeast and Midwestern states. So Connecticut's the champion there, but New York, West Virginia, Illinois are also doing really, really well. So it's really a tale of two markets. On where you're at geographically will tell you a lot about what's going to happen next to prices, how hard will it be to sell that house, who's got the negotiation advantage in your market, and it all sort of follows along those patterns. So I should probably just pause and see if you guys have any questions.
This is a really good chart because the headlines will tell you that we're millions and millions of homes behind in supply. But when you really break it down state by state, you see Colorado here, 30% excess inventory. Arizona, I think that says 30. I mean, DC is a clear outlier here. I think that says 81%, if my eyes serve me correctly. Yep. And I have to imagine that is largely being derived from the government shakeup and the layoffs that are happening at that level.
Yes.
Yeah.
Absolutely.
Yeah. I think what I get from this slide is New Mexico and Wyoming. I need to up my marketing in those two markets because I'm licensed in both of those places.
There you go.
Should be doing more loans there for sure. So, so for those of you guys who are live on the call tonight, there's quite a few of you. There's a chat box window on the right-hand side. So if you have any questions, feel free to type those in, and I'm happy to try to answer any questions that you guys have as we go along here.
Let me ask you, Lon. I mean, if I'm an investor, right? I mean, a lot of our investors that might be on here or just follow us, they're from Denver and they're looking to divest outside Denver and go to other markets. So do you look at that graph and very simply say, you know what? West Virginia is like minus 50% in inventory. I'm going to go look there, or I'm going to go look in Illinois, or I'm going to go look in Wisconsin. I know there's a lot of other economic factors involved here, but is this a good starting place for somebody that's looking at other states to go to?
Yeah. So the green circles, it's a little bit more advantageous to be a seller. The red circles, a little bit more advantage to be a buyer. So if you're selling something in Colorado, you'd want to pick another red circle state where you've got kind of the edge on the buyer side. So maybe Texas or Florida would be where you'd go to next. Or DC, they're probably giving stuff away there. We're giving them supply demand balance. But to go to a green circle state would probably be not as advantageous as a buyer. Now, if you've like I've got relatives who live in upstate New York, if they wanted to sell a property now, this would be like a great time to do it because it's a nice time to be a seller in upstate New York.
Makes sense. So we had a couple of questions roll in here. Can you talk to the single family home market in Denver area specifically?
Yeah, so the specific of what we're having here, although I don't have these slides in this deck because this is more of a national pack, we're seeing that the home prices are relatively soft, but they're kind of well supported. The condos, which tend to be more first-time buyer driven and investor driven, those two market segments are pulling back across the whole country and also in Denver. So condo prices are going down a little bit and transaction volumes are down quite a bit. So I've got 4 rental condos. I'm sort of done with those. I'd like to sell them, and this just isn't a very good time to sell a condo. So they cash flow. I'm just going to wait another year and then I'll reassess it for next year. Now, from a concession standpoint, if you're thinking about selling, concessions are about twice as likely now as they were in 2019, and the amount of the concession relative to the asking price has doubled as well. So there's actually about 4 times as many concession dollars per month now as there was in 2019 before COVID.
So you kind of answered a part of the next question here. So when is the best time to sell a C-class 1960s 3-bed condo in Lakewood in the next 2 years?
Not today. What I would do is I would reassess next spring. So What needs to happen is we open to talking about consumer confidence, and I think that's largely driven by the negative headlines about tariffs and a slightly smaller extent by Ukraine. If we can get the tariffs out of the headlines by, say, December, January, by February or March, people have forgotten about that, and you'll probably see consumer confidence go up, and you're probably going to see buyer activity across the board go up. But when there's more confidence, the snap will be the biggest with the condos, because the condos have been hurt the most. They will rebound the most as well. It's like going deeper in a trampoline, you're going to bounce a lot higher. So I would reassess in January, February, and if we see the headlines are better, consumer confidence is better, then selling in the spring, that's kind of what I'm expecting to happen. That's probably when I'll be selling my 4 condos, and maybe you will be as well.
How's the market in the Vail area? Do you see any chances for prices to go down?
They might go down a little bit, but there's still just so much demand, and there's so many people who've got so much equity. Something like half of the transactions in the Vail Valley are all cash. That's not a group of people that feels a lot of economic pressure, so I wouldn't expect a lot.
I agree.
Good questions, everybody. Feel free to
Yeah.
keep sending them over.
Yeah, please do. Those are all great. So here's the 50 largest metros across the U.S., sorted out by who's had the biggest price increase or decrease. We're looking at June of this year versus June of last year. Austin, Texas, and Tampa are doing the worst. Cleveland, Ohio is doing the best. Denver's just sort of at the bottom quartile there. But I'll send this chart out to you, so depending on which geography you're in, you can look up your specific state. So overall, it's taking about 5 days longer to sell a house this year versus last year. So although things are slower, it's not a catastrophe by any means at all. Joe, can you tell us a little bit about the DTI ratio and what that means for lending, and what this chart kind of tells you about a forward forecast for pricing?
Yeah, absolutely. So this chart breaks down how much of the average person's income do they need in order to buy a house. And the black line in the middle is 25%. That's kind of the, safe, stable number that if you make $10,000 a month pre-tax between you and your spouse, ideally you don't want to spend anything more than $2,500 a month on your housing expense, whether that's rent or, for what we're talking about, your mortgage, your principal and interest payment. And if you go back and look at 2021, rates were 2% and prices were skyrocketing. Well, the homes were really affordable from a monthly payment standpoint with those two variables. Really low rates, prices were going up, and that's the 13.3% as you see there. Now, what's happened over the last 4 years? Interest rates have nearly tripled. We went from 2.25%, 2.5% to currently roughly 6.5%. Well, with higher prices and higher rates, now we're up that it takes roughly 27% of the average person's income in order to afford their principal and interest payment. So this does one of two things. You either buy a smaller house or you make a higher monthly payment. And some folks just don't have the capability to make that higher monthly payment. So that's where they get squeezed on affordability, that maybe 3 years ago they could afford a $500,000 home. Maybe now they can only afford a $350,000 home. And that really crunches a lot of folks that maybe want to buy a new home. And they might say, back to the apprehension we were talking about earlier, you know what? It doesn't seem like a good time. I'm just going to wait. And usually their answer is, I'm going to wait for prices to go down, or I'm going to wait for interest rates to go down.
So we're kind of stuck in this situation that interest rates either need to go down, or prices have to go down, or incomes need to go up. Any one of those three things, or ideally some combination, would improve this ratio. But where we're at right now, people are paying about as much for houses on composite as they're able to afford. If that's the case, then future price appreciation is going to be limited quite a bit. This is why I think the next 5 years of appreciation in most markets will be a lot less than, say, the average of the 10 years prior. That's true in most markets in the U.S.
I agree.
Great information there. It's interesting the amount of household income required to buy a house on average by state. In Colorado, it's $160,000, over $200,000 in California. It's amazing to me. You could have 2 6-figure salaries and just barely be able to buy a 3-bedroom house in California on average. It's pretty remarkable. West Virginia, on the other hand, things are looking pretty good there financially. So something interesting is that if you are a single tax filer, when you sell your house, the first $250,000 of the gain is excluded. And if you have any gain over $250,000, then you have to pay tax on that. If you're married, the exclusion is about $500,000. So you might ask yourself, well, are there an awful lot of houses for these single filers that have had more than $250,000 of appreciation? And in Colorado, the answer is yes, 60% of them do.
Wow.
I don't think this is a well-known fact, but a lot of these people, when they do get around to selling their house, they're going to have a big tax surprise they probably weren't counting on.
This is a really interesting chart. This is new, isn't it? I hadn't seen this.
Yeah.
Yeah, this is really interesting. And a lot of folks don't realize it. And you cannot do a 1031 on your primary residence. So if you have made $300,000-$400,000 on your home and you're a single person, you're going to have a big tax bill.
Yeah. And I mean, you've won the game. Whenever you're paying a big tax bill, it means something really great happened to you and you're just having to give a little bit of it back. So we shouldn't, feel too sad about that, but it's something to be aware of.
Comment came in. So the first question, yes, these slides will be emailed out. If you don't get it for whatever reason, you can reach out to us and we'll send them. And then Leslie said, time to do installment sales.
Oh yeah, for a lot of people, that'll be a really great answer to amortize the gain out over a couple of years, and that'll be a lot more friendly way of dealing with the whole thing.
It's a great way to spread out the capital gains.
Nick, you might want to put your contact info in the chat box there, just in case you've got like a guest who doesn't get it. All right, so I don't think it's likely we're going to have a recession this year. The economists, being the geniuses they are, don't think it's overly likely we'll have a recession next year either. If we did, what happens to home prices during recessions? So the chart on the left shows you that on average, home prices go up. The major exception to that was 2008, when it was the housing crisis that caused the recession. But generally speaking, prices are flat to slightly increasing during a recession. Joe, what happens to mortgage rates in a recession?
Yeah, they go down. You generally see mortgage rates improve anywhere from 1 to, in extreme circumstances, 1981, as much as 5%. But I don't think we're going to see that much of an improvement if we were to have a recession this year or next. Probably look at, 01, 08, and 2020, take an average of those. You'll see interest rates improve between 0.8 and 1% as we exit that recession, if we have one.
Yeah, which is probably going to be a little while. And I do want to talk a little bit more about interest rates in a couple slides here. Really quickly, Joe, how many homes do we have in the foreclosure process?
Like 3. I mean, nearly 0. Even in really good times, there's always some foreclosures, but it's a very, very low amount right now. I mean, gosh, looking at Colorado, 0.1% of homes. I mean, that's a staggeringly low number. And it goes back to the leading indicator we had earlier. Almost everybody that has a mortgage is making their payment. Now, they might have to be taking out credit card debt to support their lifestyle, but they're at least making sure to make the mortgage payment.
Yep. So things are looking really, really good there. So why is that the case? So if you take a look at the chart on the left, the composite amount of equity in all the homes in America is a little over $30 trillion. The composite mortgages on all those homes is around 12. So we've got a little over, 18 or so trillion dollars of equity in the market. So if you compare that to say 2010, when we were in the middle of the financial crisis, you could see that as a country, we were underwater. The value of all the mortgages was greater than the value of all the houses. So it's not too big a surprise that we had a lot of foreclosures in 2010, just because there's so few people that had equity. We're in the polar opposite of that right now, which is a large part of why that chart looks as healthy as it does. So anyone who's waiting for like a foreclosure correction and they're going to go buy a house, you're probably going to be waiting for quite a long time. Then Joe, the part on the right, can you talk about that a bit?
Yeah, so I love this slide on the right-hand side. 38% of homes highlighted in green are owned free and clear. There's not even an opportunity for those loans to go into foreclosure because there is no loan. And then you've got 33% that have less than 50% equity and 28% that have greater than 50% equity. So in the blue, very low odds that those are going to go to foreclosure. If I've got 50% equity and I fall on hard times and I can't pay my mortgage, I'm not going to let the bank take it and take all that equity. What am I going to do? I'm going to call any one of the real estate agents on this call or whoever helped me buy the house. And I'm going to say, I really need to sell this home because I need this $300,000 of equity or whatever that number is. So very low opportunity for a foreclosure crisis. And so if you have clients that bring that up, that they say, hey, I'm waiting for the foreclosure boom, show them this slide. It is not likely to happen.
I just don't see any realistic case where that's likely to happen here. So our mortgage rate's going to go up or down. So I don't think they're going to go down very much unless we have a recession. So I'll talk about why that is. And Joe, definitely please do add in.
Absolutely.
The upper chart shows you the average mortgage rate from about 1970 to current. So the first observation here is that our current rates are what, Joe, 6.5, 6.7?
6.5. Yep.
They're right about, they're a little bit less than the historical average, which is probably closer to 7.5. So although people complain about the rates, historically speaking, these rates are just fine. The bottom chart is just the exact same information, just zoomed in for like the last year or so. So how does this mortgage rate get set? Well, there's actually not very much of a relationship between the short-term rate that's directly controlled by the Federal Reserve. They've got that lever they can go up or down. That doesn't have much of an impact. So that's a common misconception. What does drive the rate is the 10-year Treasury plus a risk premium. So we're going to talk about both of those here. So you can see the 10-year Treasury right now is around 4.4%. What that's for is if the government's running a deficit, which we certainly are, they need to raise money from the market to buy government bonds to fund the deficit. And the 10-year Treasury is the most popular way for people to go about doing that. I think it's unlikely that the 10-year is going to go down. And there's really three big drivers for that. The first is we have a much larger projection for deficits over the next 5 years or so than we had in the past due to this new tax bill that we've got. And in order for us to be able to attract more investors to buy more debt, we have to raise the interest rate just to attract all those people in. The second big driver is our credit score as a country has gone down recently. Our credit score was downgraded. Canada has a higher credit score than we do, which is a little bit embarrassing. So since we are considered to be a higher risk because we have a lower credit score, we have to offer a higher interest rate to attract people in, just like a mortgage borrower would have to. And the third one is a relatively minor one, is that inflation expectations at the moment are relatively stable. But if that changes and inflation rates are expected to go up, then the rate would probably go up as well. Joe, anything to add on to that?
No, you're spot on. I really like the credit score analogy. We see it all the time. If you have a lower credit score, you're going to pay a higher rate on your credit card. You're going to pay a higher rate on your mortgage. Credit score for the United States has been on a long, slow decline. It's going to be a higher rate. It's just like if the United States went to Chase and said, hey, we want a credit card. We don't qualify for the platinum card anymore. We qualify for maybe the gold card. It's just not quite as good. It's going to have a higher rate. Yeah.
So there's a lot, I think, more pressure on the upside to rates than there is to the downside for the government borrowing.
I completely agree.
So that's about 2/3 of the mortgage rate is driven by the 10-year Treasury, and the rest is driven by a risk premium. So the big problem here is that when in April of 2020, there was the large panic around COVID and we were all locked up in our homes. We couldn't show houses or anything like that. The Federal Reserve had to flood the market with lots of cash to stabilize the financial market so there wouldn't be any kind of a crisis. It's definitely the right thing to do. One of the ways they injected a lot of cash into the economy really quick is they bought $2.5 trillion, not billion, trillion of mortgage-backed securities. So just as a background, what a mortgage-backed security is, Joe, do you want to explain it? You do this every day.
Yeah, basically you take a lot of mortgages, put them all together, and then you can slice them up and you can buy a fraction of that security, right? So mortgage-backed security is it's a big bundle of loans. And the Federal Reserve purchased, as you said, $2.5 trillion of those. And the Federal Reserve is a quasi-government agency. They're not looking for a big return, right? They were putting money into the economy in order to spur economic growth, and it worked. But now they've said, okay, we don't want to put any more money into the economy. We're going to let these mortgage-backed securities go back to Fidelity, Bank of America, Chase, the normal buyers of mortgage-backed securities. Well, those folks want a bigger return. Those are for-profit entities. And you can invest into mortgage-backed securities through your IRA, your 401k. You probably have some in your 401k, and you want a better return. And so what happens is that risk premium needs to go up to give a better return to individuals like us and Bank of America and Chase, et cetera, versus the Federal Reserve.
So as long as the Fed is holding on to a lot of these mortgage-backed securities, and they still have 2.1 trillion of them on the books, 30% of all mortgage-backed securities are on the Federal Reserve's balance sheet. We're going to have an elevated risk premium until that gets to normal, and that's going to be 6 or 7 years.
I agree.
So I really struggle to see any macroeconomic reason why mortgage rates would drop any meaningful amount over the next couple of years, barring a recession, when historically they do go down a little bit. So if you've got clients waiting for rates to drop, don't see a path to that.
No.
Anything else on that, Joe?
No, I think we have a slide where we'll talk about the last time that folks waited a really long time for interest rates to drop. I don't know if we have that one in here. There it is. In 1971, the interest rate for a mortgage was 7.3%. If you waited for interest rates to go down, you would not have purchased a home until 1993. You would have rented for 22 years while you were waiting for interest rates to go down. During that time period, the value of real estate quadrupled. So don't wait to buy real estate, buy real estate and wait. And I completely agree with this. I think your analysis is spot on, Lon. If you're going to wait for interest rates to go back to 4%, you may never buy a home. That may never happen. And that's what I think a lot of people forget is the low rates of the 2010s to 2021. Those were the weird times. It's very normal for rates to be at 6.5%, 7%, maybe even 8%. But because it happened in recent times, we're really focused on, I want to wait for rates to go back to that. But that was the anomaly. Where we're at now is actually very, very normal.
Exactly. So I want to wrap up by talking about apartments. I am just very excited about apartments, and that's usually about 2/3 of the funds that we invest in. And I want to show you some of the logic as to why we feel that way. The first is we have not been building as many homes and rental properties in America as other developed countries. You can see that we rank dead last compared to these other large advanced economies. So we've got sort of a scarcity of housing units that are available. Let's see. Confidence for rates to drop in October. I think you'll probably see a little bit of a drop. What do you think?
I agree with that. You're not going to see rates in the fours, but I do think, we'll probably get to 6.25, maybe 5.99, paying, 1 or 2 discount points. But if you have clients that are saying, Jerome Powell is going to lower the Fed funds rate and I'm going to have a 4% rate in January, you're probably not going to have that.
I'll take that bet.
Yeah, I'd be willing to bet money on that. 5.9 to 6.1, probably. I mean, we could do that today. You'd have to pay some discount points. But depending on how long you want to stay in the home, it might still be a good deal. So if you have clients that are focused on that particular number, have them call me because I can help with that.
Absolutely. So what has happened to apartment prices? Well, since the peak in 2021, apartment prices have dropped by about 20%. By comparison, if you rewind to the great financial crisis, 2008, 9, and 10, apartment prices dropped about 30% during that correction. And you can actually see that most forms of commercial real estate all had a similar 30% drop back in 2010. So apartments were very much in sync with everybody else. If you take a look at this downturn, you can see no surprise that office has suffered the most. Industrial has actually done great, and apartments are off about 20%. It looks to me, just looking at this curve, that apartment prices have probably hit bottom and they're slowly coming out. So it's a great time to be a buyer of apartment buildings right now for that reason.
I was just going to say that slide tells me that this is a buying opportunity because we're right coming out. This is the perfect time. Probably the next 6 months is the perfect time to start buying apartments.
Yeah, it's just a lovely time. So I want to talk about demand and then supply, and then we're going to put those two together. So on the demand side, it's called absorption, when we got a prior vacant unit and we get a new tenant who takes that unit and starts paying for it. We've absorbed one vacant unit from the marketplace. And you can see in 2024, we had pretty much a record number of new apartment demand absorption that was taken offline. Depending on who did the statistics, it's somewhere between 670 and 720,000 new units of demand, which is an absolutely bonkers number. And the second quarter of this year was a similarly almost record high. First quarter, second quarter this year, I just need to update this chart, were extremely strong. Demand side had been really strong. Well, why is that? Because student loans are higher up and people can't seem to save money, and because home prices are really, really high and people can't afford to buy a house, If you can't afford to buy a house, you have to be a renter for longer. And this is what you're seeing, is that, you're squeezing the balloon on home purchases and you're getting an expansion of the balloon on the number of renters. And we're very much benefiting from that. I don't think those headwinds are going to change anytime soon. So the number of renters is going to keep growing most likely. This is just a quarterly view of what we just looked at. Second quarter was just about as good as the first quarter of this year. So just really, really strong and robust demand. So let's look on the supply side. So we had a huge number of new deliveries in 2004 and the first half of 2005. Why is that? So if you rewind in your mind to the second half of 2020, we were past the initial crisis of COVID. People were starting to calm down. There was a huge amount of liquidity that had been injected in the market. So the interest rates had gone down a lot. And the bankers have got all this cash and they really wanted to deploy it. So if you were an apartment developer coming to the bank saying, I want to borrow money to build an apartment building, they would find some way to say yes. So there's two factors that are really important to remember. The first factor is that the rates were super cheap, but they weren't fixed for very long. So as rates went up, they all got bit for that. But the second factor that's really important that nobody really recognizes is that during this window from the second half of 2020, all of 21 and the first quarter of 22, there's like this 7-quarter period where the banks were very aggressive, where they would lend a higher percentage of value than they normally would. Or if you said, I'm going to get a second mortgage on my construction project, they'd say, that's okay, we'll allow that, when normally they wouldn't. So you got to borrow a lot more money and put a lot less money down than normal. Now, when you refinance these projects, not only are you going to refinance at double the interest rate, instead of having 15 or 20% down, you're going to have 30 or 35% down. And this is why a lot of people are in trouble from the 2021 vintage properties. It's a double whammy of both the increase in the amount of down payment as well as the increase in the interest rates. So what we know is that it's like a 36-month process from the time that the bank approves your project to when you typically deliver a brand new building, and now you've got to lease it up. So since the middle of 2022, rates have gone up a bunch. Banks started requiring much bigger down payments, closer to historical norms, and the number of approved projects starting in the second half of 22 fell off a cliff. There's almost like a quarter of the number of new projects in the pipeline now that there was at the very busy sort of time. So you can look at the forward curve for the amount of supply being added in 27, 28, and 29, and it's less than half of our peak of 2024. Does that make sense?
Very much.
Yep.
Yeah, if I wanted to deliver a new apartment building today and I just started the process, I'd probably be delivering in 2029 would be the most likely delivery date.
Mm-hmm.
So you can see the number of units under construction has fallen off a cliff. It's quite a bit less than it was just like 3.5 years ago. So what this means from a supply and demand standpoint is that things are now very much in the favor of the landlord at this moment, and they're going to get more and more in favor of the landlord as time progresses over the next 36 months, because the number of new deliveries is going to fall further, and the amount of rental demand is probably going to stay very strong because it's hard for people to buy. I want to show you one element of demographics to predict what that's going to happen like as well. So if we take a look at the segment of people who are 18 to 24 years old, this is a group of people who tends to be getting out of college and getting into their first rental property. How many people do we have in this age band? And the answer is there's about 1.2 million. I'm sorry, no, it's 700,000, 600,000 of these people are in that age band. Historically speaking, the number who should be renting should be several hundred thousand renters less than that. So since we have an artificially high number of people either in college or living in their parents' basements, when they get out and get back to renting, which is what they should be doing, it's going to create even more demand for renters than we have currently. So as good as the rental demand has been, it could actually get even better yet, demographically speaking. Does that make sense?
You make me want to buy an apartment building, Lon.
I think I'm going to be buying several of them soon. So let's take a look at the 25 to 34-year-olds. So our last chart was people who are 18 to 24. Now I want to look at people who are between the age of 25 and 34. And what you notice here is that about 16% of the Americans in that age bracket are still living with their parents. And that's near the high end of the range. Historically, The average should be a little bit above 12%. So what we need to do is we need to go from our 16% current of kids living with their parents in the basement to about 12%. If you make that change, it's 940,000 new renters that are waiting on the sidelines in the basement who need to get the hell out and go rent their first place. So demand has been incredibly robust, and I think demand is actually going to continue to be really, really strong, but we have very little new supply for very good structural reasons for at least 36 months. What does that mean? Lower vacancy rates, lower concessions, and higher rent growth. So the cash flow on these apartments, and the apartments are selling for 20% less than they sold for 3 years ago. They're on sale. Would you like to buy? All this really adds up to it as an amazing environment to be an investor in multifamily.
The only problem is high rates.
Yeah.
I want to point that out. There were so many positives that you just went through. The only negative is high rates, and that can be solved with all of those other positives.
Yep. The good news is that the prices have gone down by about the amount that you need to account for the mortgage payment on the apartment building being higher, so that you can get the spread that you need to have to make a good economic profit. So the current pricing is designed on the current rates. If we get a break and the rates go down, which I don't expect, that would just be a huge value driver on top. I would assign 0 probability to that. But the prices are correct today for the high rates that we have today, which is great.
That's right.
Got a question from James. Is there a chance that living with parents is a new social norm long term? For example, it's very common in many other first world countries such as Italy, Japan.
Absolutely. You might be right about that. It might be that you've got 16% of these older, 34-year-olds living with their parents who just can't afford to move out. Or they might be taking the very wise strategy that I'm not going to pay any rent. I'm going to mooch off my parents' grocery bill, save as much money as I can, and maybe I'm just going to skip the rental stage. I'm just going to buy my first house right from my basement. That could be happening. I haven't seen any demographics to support that yet, but I've got to believe that there's probably something along those lines.
Yeah.
Good question. Well, that's it. Those are the slides I wanted to go through tonight that are pretty exciting. And do you guys have any remaining questions?
None for me. This has been great.
Yeah.
I did add in my contact information for those of you that have been on this webinar in the past. Did want to give you a short announcement that I have changed mortgage companies. I was with Castle & Cook Mortgage for 15 years, and they've been an outstanding organization, nothing but positive. But I did, as of yesterday, move to a new company called Synergy One Lending. So my phone number is the same, but I do have a new email address, jmassey@s1l.com, and would love to chat with you guys on anything you need from a financing perspective. We've got a lot of new things that are going to help investors and lots of different options for first-time buyers. So if you're one of these folks that has a 25 to 34-year-old living in your basement, have that person call me and I can help them get out of your basement. So I really appreciate you guys letting me continue to join on these calls.
Love it.
Absolutely.
For those of you guys who are realtors, which is usually about half of our people on our calls, if you're interested in getting more listings, we can help you out with that. You may know a landlord that would like to sell, but the idea of paying a lot of capital gains is unappealing, and they don't want to do another 1031 to buy another rental. We've got some tax advantage investments that can solve that problem for you. Set up a time to talk with me or Nick. We'll explain it. And if you want us to help you educate your client, you can get another listing and we can get another client. We can all win together. So irontoncapital.com/more listings YC, and we'd love to talk to you about that. Nick, anything else we should cover?
I don't think so. I mean, this has been a great presentation. I'm glad we got to go into the apartment update because it's behaving in a very different way in some ways than the residential market. And so really interesting to see. I mean, for so long, particularly in the commercial real estate market, we've had nothing but headwinds, and we're starting to get a little bit of a tailwind in our way with a supply-demand imbalance, which will be great. And like Joe said, the biggest challenge right now, is just those interest rates. And I speak from that's residential and commercial, but commercial, it's we're seeing more cap rate expansion happening as a result of these interest rates sticking high for longer. But it's exciting to see a potential tailwind in our favor that'll help drive income across all of the commercial, mostly multifamily and industrial. But it'll be really good to see some of those tailwinds start to appear. James is asking, how can I sign up for the newsletters for these calls? This one was forwarded to me. James, if you go, I'll tell you what, if you want to email me at nick@irontoncapital.com, I will get you, I'll get you on the distribution list.
Great.
And actually, James, if you want to, you can also go to our website, whatever's easiest for you, but feel free to email me and I can help you out with that.
All right. Well, thanks,
right.
guys. I really appreciate all of you taking time on the evening to be with us, and I hope you have a fantastic evening.